Dr. Anil Lamba is a practicing chartered accountant and holds degrees in commerce, law, and doctorate in taxation. He is the best selling author, financial literacy activist, and an international corporate trainer. Dr. Lamba's training programs are held internationally with a client list exceeding 2,000 large and medium sized corporations spread across several countries, including India, USA, Europe, Russia, Africa, the Middle East, and the Far East. He has also written several books and over 1,500 articles. His books, Romancing the Balance Sheet, Flirting with Stocks, Eye on the Bottom Line, and Financial Affairs of the Common Man, are currently making waves. I welcome you.
Hey folks, good morning. And the topic that I'm speaking on within the overall topic is a smaller area, but very, very critical: why businesses fail. You already mentioned many architecture firms have also failed, and partly due to this reason. So a few years back, Reserve Bank of India had conducted a study of all the sick businesses in the country. And the idea was to find out why businesses fail. Let's do some brainstorming amongst ourselves. You are all aware that India started a globalization, a liberalization program with effect from 1991. Prior to that, we were not that open as a country. Because we were not open to the world, the domestic players didn't have enough competition. And due to lack of competition, some entrepreneurs were flourishing. Post 91, the government opened up its doors. Foreign players came in. These foreign players probably had the latest technology at their disposal. It is possible that in the post 91 era, some domestic players must have found that now there is competition from these foreign players who are way ahead in technology. Compared to them, the domestic players' technology was obsolete and they didn't have the money to buy new technology. Do you think that technological obsolescence could have been responsible for a certain portion of sickness in industry? Now, there could be a second category of entrepreneurs who technology-wise were as good as anybody else. The problem was not the ability to make. Their weakness was they knew how to make, but they didn't know how to sell. Do you think marketing inefficiency can lead to sickness? There could be a third category of entrepreneurs who knew how to make and who knew how to sell. But their misfortune was they had a very militant and unreasonable trade union, which went on extended periods of strike, and for months production came to a halt. Do you think labor problem can lead to sickness? Folks, Reserve Bank of India conducted a study of all the sick businesses in the country, and their study has found out of all the sick businesses, over 95% were not sick due to any of these three reasons. That means the three reasons and some more put together were not even responsible for 5% of business failures. And over 95% businesses had failed due to one reason: financial mismanagement. And I'm giving you Indian statistics, but my statistics applies all over the world. It is an established fact, undisputed fact, that in the world, out of every 10 businesses that shut down, over 9 of them shut down because of bad finance management. And recent history has told us not only companies have shut down, entire countries and economies have shut down due to bad finance management. The entire subprime crisis of the United States can be attributed solely to bad finance management. Right now, as we speak, there are countries in Europe, Italy, Greece, Spain, Portugal. There are countries in South America, Venezuela. They are all suffering the consequences of bad finance management. But what does it mean? What does it mean when I say 90 to 95% businesses close due to bad finance management? Let me tell you what it means to me. If somebody came to me and said, my business went sick, why? I became technologically obsolete. I don't understand how to blame that person. Because suddenly this poor fellow finds in front of him a giant has cropped up as a competitor. This giant is way ahead in technology. This poor guy's technology in comparison is out of date and he doesn't have money to buy new technology. How can you blame him? If somebody comes and says, my business shut down because of labor problems, sympathies go out to him. How do you blame him? But when somebody says, my business closed down because of financial mismanagement, I think the entire blame lies on this person's shoulders. Why did his business close down? If I ask all of you sitting right now attending this session, tell me how many of you are non-finance persons? Chances are all or a majority of hands would be up. And in my opinion, that's an absolutely wrong answer. When I ask you how many of you are non-finance people, not a single hand should go up. So why is it you are saying you're a non-finance person and how is it I am saying you're not a non-finance person? Because we have a faulty perception of who a finance person is. When I asked you how many of you are non-finance people, your perception of finance person is the one who's in the finance department, the accountant perhaps. And I have always maintained maybe that person is the only person in the company who can afford to say, I'm a non-finance person. Now look at the paradox. I'm saying the person who's, let's say, the accountant, he's the only person who can afford to say, I'm a non-finance person. Rest of the company has to understand finance management is your responsibility. Because according to me, finance management is not collecting financial data, recording financial data, presenting financial data in the form of financial statement like profit loss accounts and balance sheet. That's accounting. Finance management, according to me, is the ability on the part of every individual in the organization to understand the financial implication of your actions. Guys, you must never ever forget that those of you who are in business on your own, that the single objective of setting up a business is to make profit. At one time in India, profit was considered to be a bad word, and we paid a price for that attitude. Business is run with a single objective to make profit. If I ask you what business is Tata Motors in, what will be your answer? You'll probably say they're automobile manufacturers. What business is Hilton Hotels in? You might say they're in the business of hospitality. What business are you guys in? You'll probably say we are a firm of architects. And my answer is all these three names, you guys, Tata Motors, Hilton, you're all in the same business. And the business of running a business enterprise is to make profit. Your methods are different. And when do organizations make profit? Only when either every individual or a majority of people within the organization take financially intelligent decisions. There is finance management or mismanagement in every action of every individual. So I'm trying to tell you those actions that generate profit for the organization or losses are financial actions. Every time you hire somebody, there's a financial implication. Every time you buy an equipment, it has a financial implication. Every time you quote to a customer, there's a financial implication. And all this is done by people who are not in the accounts department. And why did I call the accountant as the non-finance person? because he's the only person who does nothing to generate profit. He calculates. He's a very important person. Mind you, I'm an accountant myself, so I'm not trying to berate those guys. But I'm saying after the rest of the organization who call themselves non-finance are through with their actions, the accounts department comes into the picture, does a post-mortem and tell you whether the organization has made a profit or a loss. I am asking you, the people who call themselves non-finance are the ones engaged in the generation of profit. The people who call themselves finance people are the ones who calculate the profit. Tell me, should you call the actions that generate profit as finance, or should you call the actions that calculate profit as finance? None of you are non-finance people. And this faulty perception of what finance management is responsible for 90 to 95% of business failures in the world. So guys, when I go on and on like this, how important finance management is, what kind of grief is caused by thinking that you are non-finance people. 90 to 95% business failures can be attributed for that. And therefore, what is required is for every organization to practice good finance management. And when will good finance management happen in your organization? Only when everybody understands it is my responsibility. Chances are when I go on and on like this, one of you gets up and says, Anil, I'm convinced. I'm convinced finance management very important. And in my organization, good finance management can only happen when my finance management is good. Everybody says that. Then your next logical question to me will be, so Anil, can you tell us what is good finance management so that I can start practicing from tomorrow? That's the objective of calling me here. Now, when somebody like you would ask, what is good finance management? Can you tell us? My response used to be, I'm sorry. Good finance management is not a two-line definition. It's a whole subject. It's a whole philosophy. It takes years to learn. And then I used to feel the unfairness of it all. So what am I doing? I'm first communicating to you how important the subject is. I am perhaps creating in you a desire that I'm willing to, take the pains to learn. And when you say I'm willing and I'm ready, I say, I'm sorry, I have no answers for you. I used to wonder, can I give you a magic formula? You want to practice good finance management from tomorrow? Here is a magic formula. Do this from tomorrow. While there are no magic formulae, what I have is something pretty close to that. I am going to give you what, in my opinion, is good finance management, presented in the form of two rules. My complete conviction is you understand these two rules. They're very easy to understand. Guys, the entire subject of finance is common sense. It's not rocket science. You understand these two rules. You internalize these two rules. If you promise me never to violate these two rules, I will promise you most problems that others suffer from on account of bad finance management, you will not. I may not be able to do justice to it today. I will give you both the rules soon, but the time constraints, each rule deserves at least an hour of discussion thereafter. So I will give you the rules in a nutshell, and then I would urge you to take steps to, try and understand more because today we'll have tremendous time constraints. In fact, DP Singh, somebody give me a little reminder 5 odd minutes before I'm supposed to stop. I might forget and just carry on. So do me that favor. Now, guys, before I give you those two rules, it is understand that all of us have a working knowledge, working understanding of a balance sheet. So I'm going to quickly introduce a balance sheet to you, because without understanding a balance sheet, no intelligent financial decisions can ever be taken. This is one of the most important documents. You might be aware a balance sheet looks like this, what you can see on the screen. It has two sides. It has a liability side and the asset side. Of course, it doesn't always look like this. Nowadays, the tendency is to present it vertically. So either liabilities will be on the top or assets will be on the bottom, or vice versa. But an accountant will prepare it in a T format. There are figures on the left, there are figures on the right. Balance sheets always balance. The two-side total is the same. Why is the balance sheet always balancing? Answer is, you see, liabilities, what do liabilities mean? Liabilities means what you owe. Why do you owe that money? Because you must have taken. If I come to Mr. Singh and I say, can you give me 1 lakh rupee loan? Only then I will write in my balance sheet, I owe Mr. Singh 1 lakh rupees, correct? So liabilities tells you where the money has come from. Liabilities represent sources of money. And what are assets? Assets are stuff that you own, stuff that you possess. And how did you get to own those things? You must have spent this money and acquired the assets. So assets represent uses. And why do balance sheets balance? Obviously, they balance because if you go to the people on the left and borrow, let's say, 100 rupees or 100 crores of rupees, and you spend that 100 crores and acquire assets worth 100 crores, bound to balance. Now tell me, where does an organization get money from? An organization gets money from, first of all, you must understand when a business organization needs money, how many options does it have? It has only one option. And what is the option? Borrow. Who does an organization borrow from? It borrows from the owner. And therefore, we treat the owner and the business as separate. Borrowings from owners is called capital. And borrowing from outside, then it borrows from outsiders. Borrowing from outsiders is called a loan. When there is a single owner, then it becomes a proprietor's capital. When there are partners, it is called partner's capital. If there are a number of owners, they are called shareholders, then the capital is called share capital. Imagine this company required a total investment of 1,000 crores. It went to the owners contributed 400 crores. And then for the remaining, it went to some financial institution or somebody and borrowed another 600 crores from them. Point number one I'm trying to make is both are in the form of loans and therefore both appear as liabilities. Make sense? But what is the difference between the owner as a lender and the banker as a lender? What's the difference? The difference obviously lies in the terms of lending. On what terms did the owner lend? On what terms did the outsider lend? Folks, you understand, when a company goes to borrow, when a business goes to borrow, no lender is ever going to lend you money without asking a series of due diligence kind of questions. What kind of questions will a lender ask? The question designed to understand, number one, the need for money, the ability to intelligently deploy the money, the ability to generate revenue, the ability to service the loan, and the ability to repay the loan. Any lender would like to know these things. So when this business went to the owner and went to the banker to borrow money, both the lenders must have asked these questions. And this business must have said, folks, I'm going to take your money and I'm going to use it, first of all, to buy some fantastic assets for myself, which appear on the right-hand side. Then I will use your money, if you're a manufacturing company, to buy raw materials, to hire people. And then when my product is ready, I will use your money to do sales and marketing. And then when I have sold my product, I will make profit. And when I make profit, the business says, Mr. Owner, I will reward you. Mr. Lender, I will reward you also. And both these lenders must have said, we have no doubt at all. When you earn, of course, you will reward us. But our worry is, can you tell us what will happen in case you don't earn? And the business must have said, folks, if I earn, I will reward you. If I don't earn, how can I reward you? Listening to this kind of an answer, out of these two lenders, one of them will back out. Who will back out? Obviously, the banker. The banker will say, if my returns are going to depend upon whether you earn or you don't earn, then I'm sorry, we are not interested in lending. Banker says, I will lend on one condition. Guarantee me a return. And this business person said, banker, that's pretty unfair. If we don't earn, how can we guarantee you a return? But we all know there are times in life where beggars can't be choosers. You want the banker's money, you will have to agree to the banker's conditions also. So reluctantly, this business must have said, all right, Mr. Banker, you expect us to continue giving you a reward even when we are losing money. We will agree to that because we have no choice. We need your money badly. But then this company must have said, banker, then even we have a couple of requests. Request number one, if you expect us to carry on giving you a reward, even when we are losing money, then first of all, Mr. Banker, don't keep your expectations sky high. You want a reasonable kind of a return. Perhaps we'll be able to afford it, even when we are losing money. The banker must have said, okay, I'm happy with that 10%. You see the 10% written next to the left of the loan? And this company must have said, Mr. Banker, you want us to give you 10% when we are losing, we are agreeing to that. But then on the other hand, don't forget, we might also make profit, and we may make a huge amount of profit too. Then you don't keep an eye on that. If we're going to give you 10% when we are making losses, then we will give you the same 10% when we make pots of money. Banker must have said, fair enough. I'd rather have the assurance of a guaranteed return than have the possibility of a very high return in 1 year and then nothing in another year. Point I'm trying to make is, on what terms do outsiders lend? Outsiders lend on the condition, give us a guaranteed but a limited amount of return. Now, the owners are listening to this conversation between the company and the bank. The owners now turn around and say, we are not like the bank. We are not so unreasonable. We understand you will have ups and downs in your life. Some years you'll make profits, some years you won't make profits. Owners say, we are willing to give you our money with no guarantees whatsoever. Which means if you don't earn, we are okay if you give us nothing. But then the owners say, you understand? We might get nothing in case you make a loss. So they tell the business, if you don't earn, you may give us nothing, but to compensate for that risk, when you do earn, and after everybody's been paid off, we will take everything. Tell me, is that also fair? On what terms do bankers lend the money? Guaranteed, but limited amount of return. Owners lend money on the condition, don't want guarantees, but then don't want limits on how much we can earn either. This company takes 400 crores from the owner, 600 crores from the lender. The 1,000 crores get deployed on the right-hand side. Excellent assets are purchased. Assets are put into use. And now they start generating revenue. And once they generate revenue, they first meet their operating expenses. Then they pay interest to the bank. Then they pay income tax to the government. And the profit that is left belongs to the owner. Now, guys, imagine this company makes whatever, 800 crore of profit or a 400 crore of profit. And who was this promised to? This was promised to the owner. We'll give it to you. So now the owners will be saying, you made another 400, give it to us. But rarely will a company distribute the entire profit amongst the owners, even though they had promised. Why don't they distribute the entire profit among the owners? Owners' condition was, if you don't earn, we will take nothing. But when you do earn, we will take everything. Then why don't companies give the entire profit to the owners? And the most important reason for this is that first, I think amongst the first lessons an entrepreneur learns after starting the business is that there is no connection between the profit that a business makes and the bank balance that it has. Many people wrongly think profit means money. Guys, profit and money are two different things. If a company has a 400 crore profit, it is extremely unlikely they will have a 400 crore bank balance. In fact, the bank balance can even be negative 250 crores. And having promised to the owner, we will give everything to you, this company will not give everything to the owner. Let's say the profit is much more than 400, say 1,000 crores. They might give the owner a couple of 100 crores, and the remaining 800 is retained in the business. Now tell me, who does that belong to? That also belongs to the owner. because owner was promised we'll give you this profit. If they don't give it to them, then the company owes it to them. So the retained profit appears in your balance sheet under a heading called reserves. So what are reserves, guys? Reserves is the profit made by the company and which was promised to the owner but not given. So if it is not given, if it is left in the company, now this company owes the owner this figure also. And together, 4 plus 8, 1200 together is called the owner's net worth. In case this is a public limited company, maybe the 400 crores from shareholders was raised by way of a public issue of shares. This company had issued 40 crore shares, each carrying a face value of 10. Now the net worth has become 1200 crores and the number of shares are 40 crores. So what is the value of each share? 1200 divided by 40, 30 rupees. This is called book value per share. I'm just introducing these terms to you. Face value is the price printed on the face of the share certificate. Book profit is the net worth divided by total number of shares. And now third term is market value, for which you have to go to stock market and find out how much is this share trading for. Guys, I was trying to prove to you when I said left-hand side represents sources. Does it really represent sources? Tell me the first item, is it a source? Answer is yes. Who gave this money to the company? The owner. The second item, is it a source? Answer is yes. Who gave this money to the company? Again, the owner. The difference between the first and the second item is, in the first case, the owner physically invested the money. In the second case, the owner may not have invested money, but they left behind the profit that they legitimately could have taken home. The third item, is that a source of money? Loan? Yes. Who gave it to you? Some banker, some outsider, some lender. But organizations not only go to banks and borrow money, they also go to vendors and suppliers of goods and services and tell them, can you give us goods and services and we will pay you a month later, 2 months later, 3 months later. They buy on credit. That is also appearing over here. Is that a source of money? Answer is yes. The third item is a loan in cash. The fourth item is a loan in kind. Please understand, the left-hand side of the balance sheet, the liability side of the balance sheet, merely represents a collection of sources. And what do you do with this money? This money goes in two avenues. It goes towards creation of infrastructure. Everybody needs infrastructure. Once you set up an architecture office, you will need a space, and you will need furniture, and you will need hardware and software and multiple other things. These appear in your balance sheet under a heading called fixed assets. And depending on the nature of business, guys, if whatever money you have, you cannot exhaust it in the creation of fixed assets. Because having created fixed assets, you will now require a continuous supply of money for something called working capital. And why do you need working capital? Working capital required for three reasons. A manufacturing company, once it has created infrastructure, when a customer walks in and gives them an order, they will need to buy and invest in inventory. And they will also need to keep sufficient amounts of cash so that the day-to-day expenses and salaries and rent can continue to be paid. And then very often when they complete the order and give it to the customer says, come 30 days, 60 days, 90 days later and collect your check. They don't even get paid immediately on delivery. So they need further financial muscle power to be able to last that much more time. I'm sorry, this is the quickest introduction I could give to a balance sheet. Left-hand side tells you where the money has come from. Right-hand side tells you where the money has gone. Money comes from two avenues, owners and outsiders. Both give in two ways, direct and indirect. Owner gives you directly when they invest the money. They give indirectly when they leave behind profits. Outsiders give you directly when they give you loans in cash. They give you indirectly when they give you loans in kind. Money goes partially towards creation of infrastructure, partially towards supply of working capital. Working capital has maximum three components: inventory, cash and bank balances, debtors. Now, guys, what are these two rules? I'm going to give you in a nutshell. The first rule says if the liability side of the balance sheet represents sources and the asset side represents users, then folks, you must never ever forget. Now, guys, listen carefully, because I'm going to, as it is, devote very little time to this. It needs much more elaboration, but whatever little I'm saying, pay complete attention. The first rule says if the left-hand side represents sources and right represents users, you must always remember, never forget, that out of all these sources on the left, none are free. Money is not free. Sources come at a cost. You might say, okay, so what? So what if sources come at a cost? Because what did we do with these sources? We used them and deployed them on the right-hand side. What did you acquire out of these sources? You acquired some fantastic assets for yourself. And what kind of assets are these? Hopefully, these are productive assets. And if sources of money on the left-hand side of the balance sheet have a cost attached to them, then the utilization of money appearing on the right side of the balance sheet possess an ability to earn. Guys, remember, sources have a cost, assets have an ability to earn, and the first golden, common sense, fundamental rule of good finance management says you should never ever invest money in your business without ensuring that what you can earn from the right-hand side is at least equal to, preferably greater than, the corresponding cost of the left-hand side. What does the rule say? The rule says recognize the sources side has a cost, the user side can earn. You should invest your money in any business after making sure that what you can earn from the assets is either equal to or greater than the cost of the sources. On the one hand, this is such an elementary rule that to understand this rule, you do not even need to be literate. What do I mean by that? Let's say you catch an illiterate fellow and tell him there's a money lender sitting over there. Will you go to that money lender and borrow 10,000 rupees? This illiterate man goes to the money lender, borrows 10,000. But the money lender says, I'm going to charge you 15% interest. The moment this illiterate fellow walks out of the money lender's shop, you intercept him and tell him, now give this 10,000 to me and I will pay you 10%. What answer will you get? No. Why not? You see, this illiterate man is not using this language, but he is saying, I cannot give it to you because what you offered me just now has violated the golden rule number one. What was the golden rule number one? It said, first understand what money costs you. And then when you invest, don't invest unless you can earn a return which is equal to or greater than cost of capital. So guys, I've just now told you illiterates understand this rule. And then I'm saying this is the golden rule of good finance management. You might say, Anil, if everybody already understands this, why are you calling it a golden rule? Ladies and gentlemen, you will be amazed. You will be amazed what an illiterate person will not do. How many large corporations there are that are guilty of doing. What are they guilty of doing? They are guilty of investing their money into avenues where they don't even generate a return, which is even equal to the cost of capital. And what is scary is they don't even know it. Now, this statement, I don't expect it to make sense now. I need to give you hour and a half of talk to convince you. All I want to say is, I've been talking about this for too many years, but recently I was reading an article by one of the most reputed companies in the world called Bain and Company. That Bain and Company research has found that 9 out of 10 business, 9 out of 10 in US, routinely fail to earn even the cost of capital invested in them. What does it mean? It means where this illiterate fellow said no to you, 9 out of 10 in US would have said yes. And if that's the case in US, you can imagine what must be the case over here. How it happens, I wish I had the time to elaborate. But there's a second rule also. I said, I'll give you 2 golden rules. You went to this illiterate fellow, you said, give me that 10,000, I will pay you 10%. What answer did you get? No. So why not? He said, I'm paying 15. How can I give it to you at 10? Let's say you tell him, all right, I understand. You're paying 15, I'll be happy to give you 20%. Can he give it to you now? Is this investment opportunity satisfying rule number 1? Yes. But he may still not give it to you. Why will he not give it to you? He may not give it to you if this investment opportunity, which is satisfying rule number 1, is perhaps not satisfying rule number 2, which I haven't told you yet. In fact, rule number 2, I want you guys to draft it yourselves. I will give you the situation, you tell me the rule. When this illiterate person went to the moneylender, I want to borrow 10,000. Moneylender said, all right, but I will charge you 15% interest. And the moneylender said, Mr. Borrower, one more condition. Make sure you return this money in the next 1 month. You went to him, you said, give it to me, I will pay you 20%, and I will return the money after 2 months. Can he give it to you now? Here's an investment opportunity that satisfies rule 1, but fails to satisfy rule 2, and therefore still should not be taken up. Now, can you help me put rule 2 into words, guys? Rule 2 says, also don't forget. First, what did I tell you not to forget? Money is not free. Rule 2 says, also don't forget, none of these sources on the left side of the balance sheet are gifts. Under what heading do they appear? They appear under a heading called liabilities. What does it mean? It means every person who has lent you the money today is the same person who will be standing outside your door sometime or the other saying, I want my money back. But what did you do with it? You used this money and deployed it on the right-hand side. But the fellows on the left will ask for it back sometime or the other. So how will you give it back? And therefore, rule number 2 says, invest your money in such a way that the assets will bring the money back before the liabilities come asking for it back. So to give you in a nutshell, what are the 2 rules? The first rule says investment in assets must generate a return, which is at least equal to the cost of capital. And rule 2 says assets must bring a cash inflow before the liabilities demand and outflow. Guys, if you don't violate these 2 rules, I promise you, you will not get into trouble due to financial reasons. But even if one rule is violated, there will be a price to be paid. These are not standard rules. These are my rules. But bring me any sick company's balance sheet and I will show you which of the 2 rules was violated. Or had they not violated these rules, this company would not have been sick. Questions we can have now.
Thank you for your session.
Am I on time? I was told speak for 40 minutes. I think
yes, sir.
42.
Yes, sir. Completely in time here. Thank you so much, sir. Now, if we can please have the question from the participants. Navneet, sir.
Good morning, sir.
Yeah.
Morning.
Hello, sir. So I just wanted to know how do you decide what is a good investment for your company and what is not?
How do you decide?
What is a good investment for your company and what is not?
The investment that satisfies these 2 rules is a good one.
All right, sir. Thank you.
Any other participant? Good morning, sir. It's great to have your good insight about financial management. I just wanted to ask related to, like, as previous question, like how do we invest in particular uh, sector so that we can get a good return out of it. But if we don't understand the risk management in the financial management, so definitely there would be some risk associated with the investment. So how to deal and understand those particular concept to being an investor?
Correct. So this would actually require about 2 days to explain. The question is short, the answer is very, very long. But the greater your understanding of these statements like balance sheets, etc., the wiser your decision will be. That's all I can tell you. Because number of financial parameters are there, each of which requires hours of explanation. But when you apply all those, you will be able to understand the risk that you take. You'll be able to understand the potential of that investment. You'll be able to understand whether to go ahead or not. So I don't know how to give you that answer in one line because, like I said, the question is short, but the answer is very, very long. Right now, these are the two rules that I've said from an entrepreneur's perspective. Your answer could also apply from an individual, where to invest your money, which kind of shares to buy. So these are all, each question will have a different answer. Right now, the perspective is of a business person, and this is the input that I've given you for that.
Thank you so much.
Let's put a question.
I can see one question in the chat, that is there a simplified way or a thumb rule to understand how software investment are supposed to pay back for projects in an architectural small firm?
You see, one of the things you will have to learn sooner or later is the technique called the net present value technique of evaluating expenditure. I'm assuming if any investment, even if you make an investment in software, hopefully it will help you generate some inflow in the future. So you're investing certain money today, you're earning in the future. Now there is something called discounted cash flow technique or the net present value technique. Those techniques will help you understand whether that investment is worthwhile or not. But again, understanding that requires a number of hours. But do take steps to learn that method, because that is the most important method to be used for evaluating any capital expenditure that you are making. So there are some assets which you buy which are playing a support role, but there are others which will help you generate inflow in the future. The ones which will generate inflow are relatively easier to evaluate. The others become what is known as non-performing assets. And the biggest, I think, what takes a company down fastest is when a company possesses a very large percentage of non-performing assets. You've got to make sure a maximum percentage of your investment goes into performing rather than non-performing. If they are non-performing, ensure that they are essential non-performing assets, not non-essential. Correct, Raj Kamal. You're absolutely right. And therefore, the biggest skill is how to project the inflows. That you have raised an extremely important point, because you're investing today, you will earn in the future. And therefore, these calculations done by immature people are useless. The same philosophy as computers, garbage in, garbage out. If your input is useless, your output will also be useless. And therefore, the most critical area is how to do future projections. Amongst the clients that we train are very, very large companies. Like L&T is one company where we are training in one company about 100,000 people alone. Now, each project of theirs, the small project of L&T is about 2,000, 3,000 crores. And the bigger projects, single projects, are 15,000, 18,000, 20,000 crores. Can you imagine? Decision has to be taken now. Income will come, God knows in how many years. And the technique we use, this is one technique we teach them across the board. Every capital expenditure, first understand how to work out what is known as an IRR of the project and the NPV and the discounted cash flow and so on. But then crazy things happen sometimes in certain companies, because there are certain people who are very gung-ho about a project. They want to do it. Management has certain criteria. They do some projections and they realize it will not meet the management criteria. Then what do? They revise the projections. I think that's a criminal act. And therefore, the most critical, Rajkamal, what you brought out is a very, very important point.
More questions are welcome. If some, yeah, we have. Um,
Keshav, it's a very good thing, much better than what was there before. Nothing will solve it completely, but to a certain extent, yes. This was, I think, a welcome modification that they made to that. Thumb rule for managing expenditure. Sanket, there are no thumb rules. Every case by case, it will vary. And therefore, an understanding of finance, understanding of profit loss, balance sheet, etc., is critical, guys. One can't even say you should try and always keep your expenditure lesser than your income, because sometimes you have to spend more in the initial period. Losses are part and parcel of any business. So sometimes your expenditure necessarily has to be higher than the income. So you have to make sure whether your expenditure that you're making is prudent one or not a prudent one. Two people may be spending the same amount, but one person spends in a foolish way, another person spends in a sensible way. The amount of expenditure may be same. So you can't link it only on the amount. It is where you spend. What is the purpose for which you spend? What is the productivity of that expenditure? Wasteful expenditure is what will lead to problems. If there's some means or rule to understand a permutation of the investment for external sources at the time of return. Amit, here I have a little different controversial view. Lots of people will tell you that debt is not good. Companies get up and proudly say we are debt-free company and think they are making a big claim. According to me, debt probably is the cheapest form of money available. So problem is not with debt. Problem lies with violation of these two rules that I told you. Rule number one says, make sure where you invest, you can earn equal to or greater than what it costs you. If you go to a bank and take a loan and it costs you, say, 12%, and you don't even possess the ability to earn, say, 7 or 8 or 9%, and then you say, I got into trouble because I took a loan. That's foolish. That has violated rule number one. That kind of loan should never have been taken. But suppose the banker is charging you 12% and you can earn 20%, and you don't have the money. Your choice is either you let go the opportunity or you go from the bank, borrow, and use that opportunity. By all means, do it. But that's not enough. Rule 2 is equally important. Rule 2 says inflow should happen before the outflow has to happen. If the banker says return the money in the next 5 years and you have to deploy it in such a way that it will not come back for 7 or 8 years, now you got into trouble because you violated rule number 2. But if these two rules are not violated, the more you borrow, the more you will prosper. Because if you don't use borrowed money, what money will you use to grow? Either you are saying I'm going to stop growing, or you will say I will use owner's money. And the one more big misconception people have is that owner's money is free. Whereas the fact is, owner's money is the most expensive source of money available. Personally, I would put it roughly about at least 3 times the cost of borrowing. If borrowing costs you about 12 to 14%, owner's money should be considered to be 40 to 50%. Now, if a business can afford owner's money, do you think it can't afford borrowed money? Because the only way you can justify if you don't take a loan and saying I'll put own money is saying this project can earn for me 50%. Then if it can earn, then it can definitely afford borrowed money also. So problem is, so there is no rule. Bankers will give you debt equity ratios and all that. But that is for a banker's perspective, not for your perspective. So investment from external sources should be taken if these two rules are not violated. Otherwise, they should not be taken.
Any more questions from anyone?
Sujata wants to ask something. She has raised.
Yes, sir. Sir,
Yes.
I want to ask one thing, that always we talk that on assets we get depreciation. So then what is the role of depreciation in
You
the whole?
see, every rupee that you spend in a business has to be recovered. How do you recover? It has to be recovered from the business's income. But all money spent doesn't have to be recovered from current year's income. For example, if your current year's income is 1 crore and if your salary bill is 12 lakhs, it better be recovered from this year's income. But suppose you buy a so-called asset which will last you for 5 years. Then if the asset will generate income for 5 years, why should the entire thing be recovered from this year's income? Then you say, I have to recover the cost of that asset also, but I don't mind recovering it over a period of 5 years because it will help me earn over a period of 5 years. So when you buy, let us say, a 50 lakh rupee worth of asset, it will be shown as an asset in your balance sheet, and 1/5 will be transferred to the profit loss account as an expense. In other words, depreciation is a mode of recovery of the cost of the assets. Because you agreed I'll recover it over 5 years, you divide the cost of it going to the profit loss account over a period of 5 years. But please remember, ultimate destination of every rupee spent is the expenses side of profit loss account. Asset is only a temporary phase. So I always call a balance sheet as a go down, where an item will be stored till it can go to the profit loss account.
Thank you very much, sir.
Thank you, Gurudat.
Any more questions from the participants?
I think you also ran out of time. You'll have to move to the next speaker also. No?
Yeah. All right. So I think that was the questions that we had. I would request DP sir to please thank the speaker, give the word of thanks, and please conclude the session.
Thank you, Prerna. And I would like to thank as well as congratulate architect Dr. Anil Lamba. I'm sorry, being in this profession of architecture, Dr. Anil Lamba, to actually instigate our participants to look forward and take up such courses in financial management, which is, I think, training is a very little investment against the losses which we go through in our companies. So I believe that this has actually instigated our minds to take up such courses and training in financial management, which can help our business to grow, as well as give us an insights for starting a new business where the balance sheet is clean from day one. So because I know it's very difficult to clean the balance sheets after 2 or 3 or 5 years are passed on, to bring it to that level that now it's working with the knowledge of finance and taxation systems. So thank you so much, sir.